Imagine seeing almost every single loan, bond, and deposit held by every significant bank across the entire European Union in one place. That is no longer a daydream. On August 7, 2026, the ECB published consolidated banking data for end March 2026, and for the first time it covers 99% of the EU banking sector's balance sheet. The headline figure is staggering. Total assets of EU-headquartered credit institutions reached €34.33 trillion, up 3.63% from €33.13 trillion a year earlier. That €1.2 trillion increase in just 12 months tells us something big is happening. But here on Monday, August 10, 2026, the real bombshell is not the growth rate, it is the breathtaking breadth of coverage. Regulators, analysts, and even rival banks can now see into virtually every significant balance sheet in the bloc. This is not just a data dump. It is a structural shift in financial transparency. So why was this released now, and what does the number actually reveal about the health of your bank? To understand why today matters, you need to know what changed. The ECB has published consolidated banking data for years, but historically it captured only a subset, typically around 80% of the sector, weighted toward the largest institutions. The new release draws on what is effectively a consolidated tape for bank balance sheets, pooling granular submissions from national central banks and harmonizing them under a single methodology. This is a direct offspring of the Capital Markets Union push to eliminate national fragmentation. Now, 99% of the EU banking sector's total assets are included, covering everything from global giants to smaller, regionally focused credit institutions. That leap is not merely cosmetic. It slashes the hidden corners where risk can accumulate unseen. The data shows that the aggregate asset growth was broad-based, not skewed by a few outlier banks, which strongly suggests a systemic, organic expansion rather than a one-off event. Let us dissect that 3.63% growth. In a Eurozone still calibrating interest rates amid moderate economic expansion, a near 4% annual asset increase signals a healthy but not overheated banking environment. The ECB's accompanying commentary highlights stable credit quality and robust capital strength. That means the loan books are growing, but the share of non-performing loans has not spiked, which is a crucial distinction. Much of the asset expansion likely comes from mortgage lending and corporate credit as businesses invest in digital and green transitions. However, an analyst must ask the uncomfortable question: are we storing up future trouble? When balance sheets swell this quickly, even in a well-supervised system, pockets of excess can form. The new transparency acts as an early warning system. If hidden concentration risk in commercial real estate or leveraged loans exists, the expanded dataset makes it far harder to hide. On balance, the message is reassuring. EU banks entered spring 2026 well-capitalized and growing responsibly. How does a Brussels data release affect your wallet on a Monday morning? Quite directly. The ECB's supervisory arm and the Single Resolution Board will use this information to calibrate capital buffers and set macroprudential policies for the rest of 2026. If the data show broad-based strength, the pressure to raise counter-cyclical buffers diminishes, keeping lending conditions loose and mortgage rates competitive. If, however, future iterations reveal a deterioration, we could see targeted intervention. For investors, the near-total transparency reduces the unknown premium that often depresses bank stock valuations. Analysts at PwC and other firms have already noted that this dataset, combined with the EBA's new technical standards published in July, creates the most comprehensive view of European banking ever. For everyday savers, it provides a quiet confidence that the institution holding their deposits is under constant, rigorous scrutiny. That is the practical dividend of 99% coverage. Look ahead to the remainder of 2026. The ECB will update this consolidated dataset quarterly, and each release will be compared against this new March benchmark. The big near-term catalyst is the 2026 EU-wide stress test exercise, which will now be underpinned by a far richer starting dataset. Expect regulators to probe areas that were previously opaque, like cross-border intragroup exposures within banking conglomerates. There is also an intriguing competitive dimension. When 99% of rivals' aggregate balance sheet data is publicly available, banks will benchmark themselves more aggressively. That could spur further consolidation in the EU banking sector, a trend already bubbling in Italy and Spain. For the UK viewer, this comprehensive Eurozone picture provides the clearest possible comparator for the Bank of England's own prudential regime post-Brexit. Watch for the ECB's next release in November 2026. So on August 10, 2026, the EU banking sector stands at €34.33 trillion, 3.63% larger than a year ago, but more importantly, 99% visible to the world. This is a victory for accountability over opacity. The data confirms that the system is growing steadily and is well fortified with capital, yet it also plants the seeds for much sharper discipline in the months ahead. The next time someone tells you European banks are a black box, you can point to this dataset. The challenge now shifts from simply measuring assets to acting on the insights, and that is where the real test for policymakers begins. If you found this deep dive valuable, subscribe and tap the bell to stay ahead of every major shift in global finance. The numbers never sleep, and neither should your analysis.